Good morning. This is Global Markets Daily Brief. I am Jonathan Simkowitz. It is Monday, March the 16th, 2026. The headlines this week are about whether the Gulf states can survive the Iran war. The images are striking. Smoke over Dubai, fires at Ras Tanura, force majeure declarations from Qatar. But if you are allocating capital, the question is not whether these countries survive. Of course they survive. Their sovereign wealth funds hold more than $5 trillion in assets. Their defense systems have intercepted the vast majority of incoming projectiles. The real question is whether the economic model that made the Gulf the fastest-growing capital formation hub in the world over the past decade still functions in a region that the market now prices as an active war zone. That is the capital allocation question that matters. Let me walk through what has happened. Iran has targeted all 6 members of the Gulf Cooperation Council since the war began on February 28. The UAE absorbed the heaviest barrage. Reports indicate roughly 174 ballistic missiles and nearly 700 drones were fired at Emirati territory in the first days alone. Most were intercepted, but the ones that got through hit infrastructure that sits at the center of the global economy. An Amazon Web Services data center in Dubai sustained damage from intercepted drone shrapnel. Jebel Ali Port, which accounts for roughly 36% of Dubai's gross domestic product, suspended operations. Nasdaq Dubai and all UAE stock exchanges halted trading. Saudi Arabia's Ras Tanura refinery, the kingdom's largest, was forced to shut down after drone strikes caused fires at the facility. Qatar declared force majeure on its entire liquefied natural gas export operation after Iranian drones struck facilities at Ras Laffan and May Said. Qatar accounts for roughly 20% of global LNG supply. That supply is now offline, with no alternative export route available, since Qatar, unlike Saudi Arabia, cannot reroute through pipelines to the Red Sea. Kuwait reported attacks on its main international airport and defense installations. Bahrain's state oil company declared force majeure after a refinery fire. Explosions were reported in downtown Dubai. Airports across the UAE, Qatar, and Bahrain saw more than 70% of flights canceled. The region's tourism sector is estimated to be losing roughly $600 million per day. Gulf equity markets cratered where they were still open. Saudi and Qatari stock prices slid sharply. The collective oil production decline across Saudi Arabia, the UAE, Kuwait, and Iraq reached at least 10 million barrels per day as of the 12th of March. This is, by any measure, the largest supply disruption in the history of the global oil market. That is the first-order reaction. Let's step back. The consensus framing right now is that the Gulf states are passive victims caught in the crossfire between the United States, Israel, and Iran. There is truth in that framing. These countries did not initiate this conflict. They warned Washington against it. They are now absorbing strikes they spent years of diplomatic engagement trying to prevent. But the consensus framing is incomplete in several important ways, and those gaps matter for capital allocation. First, the market is treating the Gulf states as a monolithic bloc. They are not. The vulnerability profile differs enormously across the 6 GCC members. Qatar is the most exposed in the near term because its entire LNG export infrastructure flows through the Strait of Hormuz with no bypass option. 93% of all LNG traffic through the strait originates from Qatar. The force majeure declaration is not precautionary. It reflects a physical inability to deliver contracted volumes. Recovery timelines, even after a ceasefire, could stretch to at least a month. The UAE faces a different kind of exposure. Its economy has been the most diversified away from hydrocarbons. Tourism, logistics, finance, and technology services now constitute the bulk of Dubai's output. But that diversification is precisely what makes the UAE vulnerable to this particular shock. Those sectors depend on the perception of stability. When drones hit data centers and ports suspend operations, the reputational damage compounds faster than in a purely oil-dependent economy. Foreign direct investment commitments will be reassessed. Hotel bookings have collapsed. Aviation is paralyzed. Saudi Arabia occupies a different strategic position entirely. The kingdom has redundant export infrastructure, including the East-West pipeline that can reroute crude to the Red Sea terminals, bypassing the Strait of Hormuz. Its sovereign reserves are deeper. The Sovereign Wealth Fund, the public investment fund, manages over $700 million. And critically, analysts note that Saudi Arabia stands to benefit geopolitically from a weakened Iran over the medium term. The kingdom may emerge from this conflict as the dominant regional power, even as it absorbs near-term infrastructure damage. Now, what is priced in and what is not? Markets have priced in the oil supply disruption. Brent crude closed last week above $103 a barrel. The strategic reserve release of 400 million barrels is well understood. What is less well priced is the second-order effect on the Gulf economic model itself. 3 of the 4 major Gulf economies have quietly begun reviewing whether force majeure clauses can be invoked on existing investment contracts with the United States. The Financial Times reported that Saudi Arabia, the UAE, and Kuwait are jointly reassessing current and future financial commitments to Washington. Gulf sovereign wealth funds invested over $70 billion in the U.S. in 2025 alone, primarily in artificial intelligence and infrastructure. Those flows are now under review. If that capital redirection moves from discussion to execution, the implications for U.S. asset markets are significant. Collectively, these funds hold more than $2 trillion in American equities, bonds, and real estate. The market is also underpricing the duration risk on Gulf tourism and aviation. The region was projected to generate roughly $200 billion in tourism revenue this year. That forecast is now in serious jeopardy. Major sporting events have been canceled, including the Bahrain and Saudi F1 races. Even a swift ceasefire does not immediately restore traveler confidence to a region that just experienced the first simultaneous attack on all 6 GCC states in modern history. My base case is that the Gulf states survive this crisis with their core fiscal positions intact, but with their post-oil economic transformation strategies materially delayed. I assign roughly 60% probability that the conflict de-escalates sufficiently within 4 to 6 weeks to allow partial reopening of the Strait of Hormuz and a gradual resumption of Gulf economic activity. But even in that scenario, the reputational damage to the Gulf as a safe, stable hub for global capital is real and will take quarters, not weeks, to repair. Here's how I frame the 3 scenarios. The base case sees a managed de-escalation over the next 4 to 6 weeks. The Strait of Hormuz partially reopens, Gulf energy exports resume at reduced capacity, infrastructure repair begins at Ras Tanura and Ras Laffan, tourism and aviation slowly normalize, sovereign wealth fund investment reviews are paused but not reversed, Gulf equity markets reopen and find a floor roughly 15 to 20% below pre-war levels. The key variable here is duration. Every additional week of conflict compounds the damage to investor confidence in ways that financial reserves alone cannot offset. The bull case for Gulf-linked assets requires a rapid ceasefire within the next 2 weeks. In that scenario, the oil premium unwinds quickly. Gulf markets rally sharply on relief. The narrative shifts to reconstruction spending, which itself could become a growth catalyst. Saudi Arabia, with its pipeline redundancy and fiscal depth, would likely lead any recovery. The UAE would follow, but with a longer confidence recovery timeline, given the direct strikes on civilian and commercial infrastructure in Dubai and Abu Dhabi. The bear case is a prolonged conflict lasting months. In that scenario, the Gulf economic model faces a genuine stress test. Qatar's fiscal position deteriorates rapidly without LNG revenue. The UAE faces sustained capital flight as foreign businesses and expatriate workers reassess their presence. Iraq, which derives 90% of its budget from oil revenue, faces a fiscal emergency. Gulf sovereign wealth funds begin liquidating foreign assets not as strategic leverage, but out of fiscal necessity. That liquidation, even if phased, would introduce significant selling pressure into U.S. equity and treasury markets at a time when the American fiscal position is already strained. I assign this scenario roughly a 20% probability, but its tail risk implications for global portfolio construction are severe. One consideration that deserves special attention. The Gulf states are not just economic actors in this conflict, they are becoming potential strategic actors. Reports indicate that Gulf leaders are debating whether to open their airspace to U.S. operations, provide active military support, or even conduct retaliatory strikes against Iranian launch sites.
Any of those escalation paths would fundamentally change the character of the conflict and would require an immediate repricing of regional risk across every asset class. The distinction between the Gulf as bystander and the Gulf as belligerent is perhaps the single most important binary outcome to monitor over the next 2 weeks. Here is what to watch. First, the diplomatic channel. Any credible ceasefire framework or even a partial reopening agreement for the Strait of Hormuz would be the most powerful catalyst for a repricing of Gulf risk. Watch for language from Gulf foreign ministers that shifts from condemnation toward negotiation. That shift signals a change in the probability distribution. Second, watch the sovereign wealth fund flows. If the review of U.S. investment commitments moves beyond internal discussion and into visible asset reallocation, the impact will propagate well beyond the Gulf. $2 trillion in U.S. holdings represents a systemic exposure. Even partial liquidation at this juncture would be felt in treasury yields, equity valuations, and dollar liquidity broadly. This is market commentary, not financial advice. Markets move on narratives. Capital moves on probabilities. If you found this analysis useful, subscribe to Global Markets Daily Brief. We publish every weekday. Hit the notification bell so you do not miss an episode. I will see you tomorrow.